Today we're looking at 5 high-yield, undervalued dividend stocks. As always, we'll look at the historical performance. We'll talk about their dividend safety. We'll look at their financial metrics and run them through the valuation model, getting to the intrinsic value, as well as our acceptable buy price, factoring in our margin of safety, and looking towards Wall Street to see their forecast for the next 12 months. So the first company we're looking at today is Pfizer. Now this is one that has been hammered down 32% over the last 12 months, right there at their 52-week low, with a yield of over 6% and a forward PE of 12.3. Now, if this is one you have been holding over the last 10 years, you would be down 8.2%, although factoring that doesn't include those dividends reinvested, and we can see all-time highs at around $60 in 2021 in December. Dividend safety score nonetheless looking pretty strong, 75. It does look to be safe. Market cap 154 billion, is a mega cap company. In terms of those recessionary metrics, for those that see a recession inbound, well, they cut the dividend during the last recession. Recession sales, they had above average growth, -6% versus the S&P's -12. They also slightly outperformed the S&P, -45 versus the S&P's -55. Dividend growth pretty poor, in fact 2.4% in December 2023. Remember, on the channel we advocate at least 4% to keep up in line with inflation. Positive to note, 4% over the last 5 years and 5% over the last 20. They have also been increasing those dividends consecutively for the last 13 years. In terms of dividend yield theory, now it states a company is undervalued when the current yield sits above the 5-year average. So we have that sign on the yield, 6.17 versus the 5-year 3.94. But we do note the forward P sits fairly in line at 12.3 with the average at 12 for the last 5 years. Do consider though, we're not looking at any of these models in isolation, and we'll conclude towards the end with the healthcare sector P much higher at 17.2. In terms of the free cash flow payout, as always, we do prefer to draw your attention to the free cash flow as the earnings is susceptible to manipulation by management through accounting. The reason for this, in 2023, if you were to look, you would see 89% on the earnings payout. In 2023, on the free cash flow, this signals that management paid out more in dividends than they generated in free cash flow. 2024, it is coming down substantially, but do bear in mind it is still over 100%. Free cash flow per share as well, we can see it has been decreasing over the last 10 years, 85 cents in 2023. On a more positive note, 2024, they are expecting this to nearly double. When we factor in the sales growth, we can see COVID was very strong for this company, 95% in 2021 during the pandemic, double digit in the following year, but we can see in 2023, not surprisingly, their top line is down -42%. Total sales then 50 billion in 2014, 60 or just under that in 2023. So very minimal growth over the period, and if you factor in inflation in real terms, it is about pretty much even. Shares outstanding though, they have returned excess cash to investor pockets by doing share buybacks, reducing it from 6.42 billion to 5.71 in the latest period. ROIC, as always, we do want to see a minimum of 10%, and what we can see up to 2022, it was pretty decent, at least at a minimum around that level. 2023, do bear in mind though, this has dropped to around 3%, something just to flag and to consider when we do see next year's annual report. In terms of the margins then, we do note for the operating side, we want at least 12% as a bare minimum. It did hit that every single year. 2023 was a bit of a struggle. We do see that 9%, and we also take into account the share price was hammered. Therefore, we do understand based on these metrics, especially the free cash flow margin also suffered as well from 2022. Nonetheless, they aren't the worst metrics. Again, just something similar to the ROIC to consider moving forwards and maybe factor into your essential margin of safety. Net debt to EBITDA, earnings before interest, tax, depreciation, amortization. Remember that correlates to both the balance sheet safety as well as the dividend safety. 4.94, now this is pretty high, especially when we want to see it below 3. The positive to take from this, that in 2024 they are expecting this to come down to 2.97, but again, just a few different metrics for Pfizer that I would say you should keep in mind when receiving their quarterly reports and to factor in when we now take a look at that valuation. So let's jump into the valuation of Pfizer. As always, if you do enjoy the content, value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now on the channel, when we do our deep dives, and we have done one recently for Pfizer in fact, so do check that out if you're interested, we do run through every single model. For today's episode, we're just going to jump straight into the intrinsic value, and we arrive at around $31. We always use a margin of safety, which we start off with 10%, and we use that if we believe it meets three criteria: a wide moat, strong financial metrics, and good forward-looking data. If you believe that for Pfizer, it would be a buy up to $28. We go till it's near the current trading price. It isn't quite there yet, so actually for Pfizer, because the price has come up a little over the last few weeks, we see around a 10 to 15% MOS level. In terms of Wall Street and their forecast, well, they have a price target of $32, so they do see this as very undervalued with a strong buy at that 32 price target, as well as a 17% upside. But also factor in, you are locking in a fairly strong yield at over 6%. The next stock that we are taking a look at is EPD Enterprise Product Partners, up 8% over the last year. It is in fact trading towards the upper end of the 52-week range with a yield of 7.4%, a forward P of over 10, and if you've been holding this over the last 10 years, do bear in mind you would be down 18%. We can see their all-time highs around $40 in 2014. Now looking at the dividend safety, it does look to be safe, a score of 65, market cap 61 billion, and we can see when looking at recessionary metrics, they increased the dividend over the last recessionary period. They had below average growth, but they did in fact outperform the S&P with their negative 37% recession return. They had a fairly decent 5% dividend growth over the last 4 years, so you are getting a yield over 7% plus an above inflation increase. Over the last 5 years at 3%, slightly lower. Over the longer term, that 5% is looking pretty solid when you do factor in your starting percentage. They're also a dividend aristocrat. They have been increasing those dividends for the last 25 years. Now, when we do take a look at dividend yield theory, we can see it does look to be reasonably valued with the current yield roughly in line with the 5-year average, and the same could be said for the forward P to DCF ratio. When we do also take a look at the energy P to DCF, it is also in line. Now, typically, we do like to look at the free cash flow. However, for LMPs, we do draw your attention to the DCF payout, which is the distributable cash flow. Now, we want below 90% for MLPs. What we can see, it is below that every single year. In fact, has been decreasing. 2023 and 2024 expected at 58% is still pretty solid. Now, when we take a look at the DCF per share, it is also increasing. We do understand the inconsistent nature, but nonetheless, 215 to 346. 2024 continually expected to increase. So again, looking positive, not just over the longer term, but also in 2024. Moving on then, we get to the DCF per share growth. Now, this is also important to understand how much the actual per share is increasing on a percentage format. Over the last year, pretty poor, negative 2%. The last 2 years looking much better with 2024 expected 3%. But one thing to understand is this is a very cyclical company, and we can see that on the top line. Double-digit negative growth followed by double-digit positive growth and so on. Remember, one key thing with cyclical companies, you want to buy them when they are out of favor, when no one wants them and they are very cheap, and then ride them to when they do increase quite significantly. So let's take a look at the essential numbers then. So the top line has gone from around 48 billion in 2014 to around 50 billion in 2023. So we can see the relatively little movement over the longer period, but because of the cyclical nature, we can understand why we do see the peaks and troughs across. Shares outstanding though, this is very common. We do expect them to issue shares, and we can see they have done exactly that, increasing from 1.9 billion in 2014 to 2.19 in the more recent period. ROIC then, what we can see is it increasing over the longer term. I always like to see that. Does give me faith that management are able to effectively allocate their capital. 11% over the last 2 years, looking pretty strong. Ideally, we want to see a minimum of 10%, which is what we have seen over the last 5 to 6 years. Operating margin as well, looking pretty decent. We want to see around a 12%, so we can see for the majority of the period, it has been straddling along that level. 13% in 2023, 11% in the previous year does look to be acceptable. Now finally, the net debt to EBITDA, remember earnings before interest, tax, depreciation, amortization. It has been decreasing over the longer term. 4.5 is the absolute max that we want to see. 3.04 in 2023, 2.9 in 2024 expected. So it is moving in the right direction. We can see with their high yield that dividend does look to be safe. Now, in terms of their valuation, let's get to the intrinsic value. And don't forget, you can grab a copy of this model if you want to get to the intrinsic value as well as the acceptable buy price, given your own margin of safety, whether it's companies in your portfolio, those on your watch list, or even if you want to run through these companies based on your own numbers. Margin of safety then 10%, we see a buy up to $33, 15% up to $30.92, and at 20% we can see still showing signs of a buy. Not quite there yet at 25%, so we see for EPD in today's episode a 20 to 25% MOS level, with Wall Street forecasting nice 16% upside with a price target of $32.45. So bear in mind, with these two stocks we have seen so far, you are getting a pretty decent upside per Wall Street, although we would say take that with a pinch of salt and always do your own due diligence. Plus, you're also getting a very nice starting yield. Now, before we move to the next stock, just to let you know, we have released our latest free weekly article. If you want to gain access to this or of any of the other articles, all completely free, click on the pinned comment below and you can get instant access. So the next stock we're taking a look at is British American Tobacco. Now, this is down around 21% over the last year, trading not too far off its 52-week low, with the yield now nearly touching 10%, a forward P of 6.4, and bear in mind, over the last 10 years, this is down around 45%. Again, doesn't include those dividends reinvested, and we can see all-time highs around $72. Now, the dividend is borderline safe with a score of 45, market cap 66 billion. It is a large cap company. Last recession, well, they increased the dividend during 07-09. They had plus 4.8% sales, which was very solid, and they also outperformed the S&P with that negative 31% return. Now, they had a 2% increase in February 2024, 3% over the last 5 years on average, 9% over the last 20 years, although do bear in mind they do pay this out in British pounds, so the FX rate could change these numbers very slightly, and they're 1 year away from becoming a dividend aristocrat. Now, in terms of dividend yield theory on both sides, we see both the yield higher than the 5-year average as well as the forward PE below the 5-year average, so that double sign of undervaluation, coupled with the fact that the consumer staples sector PE is much higher at 20.3. In terms of the free cash flow payout, below 85%, which is the maximum we want to see for tobacco companies pretty much from 2018 onwards. 51 in 2023, 65 expected in 2024, so no real worries based on this information, but again, something you can keep an eye on over the years. Free cash flow per share also increased quite significantly over the last 10 years, although do note that 2024 they are expecting that free cash flow to drop down to 362. Sales growth, well, again, this is the tobacco industry, so you have to understand the rules, the regulations, and whether or not you do see their top line continuing to increase, or if you see this as a dying industry. 2022, pretty decent 8% growth, especially when we want to see 3 to 7% for steady, moderate growth to the top line. 2023, however, negative 1%. So the top line over the last 10 years has pretty much nearly doubled from 14 billion to 27.3. They've also done the opposite of what we like. They have diluted your position. They've issued shares going from 1.87 billion to 2.23. ROIC, now always look for these metrics. What we want to see is two things now. Not just over 10%, but we also want to see the consistency, and it is pretty inconsistent. The only positive to note in 2023, 12% is pretty strong, but again, over the last 6 years before that, it was in the single digits, something just to keep an eye on moving forwards. Both operating margin and free cash flow margin looking pretty positive. We see the operational efficiency with the margins increasing from 36 to 46% in the more recent year. Likewise, with the free cash flow margin, the last 4 to 5 years in the mid-30s is very strong. So they are producing some very strong free cash flows. Net debt to EBITDA, now we want to see no higher than 3, so we can understand why their borderline safety comes from, as this directly correlates to that number. 2.65 in 2023. Now, it is expected to go slightly higher in 2024. Not above the 3 level, but something just to keep in mind. So in terms of the valuation for BTI in today's episode, the intrinsic value is arriving at a total of $43. With a current price of $29.61, your margin of safety here will really come down to your risk reward as well as your investment thesis and how you see this industry taking place over the next 10 to 20 years. So it is still a buy at 10%, at 20% still a buy, and we keep going till it's near the current trading price, and we have a 30% margin of safety. Now, there will be investors who will either not want to touch this market, or there'll be investors who want a certain large margin of safety before entering. That could be 30%, or it could be a little bit more. In terms of Wall Street and their forecast, well, they see the price going to around $40, 39 to 40 over the next 12 months, with huge upside of 33%, again locking in a yield that's nearly touching 10%, whilst Wall Street are forecasting some very, very strong upside. As always, when we are going through these companies, let me know your thoughts, whether or not you're adding to any of these, whether these are on your watch list, or maybe for whatever reason you are bearish on these companies or industries. The next company that we are taking a look at is ENB, Enbridge Incorporated, down 7% over the last year, in the midpoint of the 52-week range with another yield of over 7%, forward P of 17.22, and over the last 10 years they have been trending down around 19%, with their all-time highs April 2015 of $54. Now, dividend safety, again, another safe dividend score of 70, market cap 76 billion, a large cap company. In terms of those recessionary metrics, well, they increased the dividend. They had below average growth, but they significantly outperformed the S&P with their negative 23% return. Dividend growth, well, just under that inflation that we like to see at 4%, although over the last 5 years and over the last 20 years, pretty decent increases to their dividend, which already sits at a very nice starting yield. Not only are they a dividend aristocrat with 28 years of consecutive increases, and they have also been paying a dividend for the last 71 years without a reduction. In terms of dividend yield theory, again, the double sign of undervaluation, 7.52 yield over the 6.79 rolling average, and we do see the P to DCF ratio of 8.9 below 9.8. When we compare it, however, to the energy P to DCF, it is slightly higher at 8.9 versus energy's 7.9. Now, when we take a look at the DCF payout, we again 70% or below is the preference for pipelines, 66 in 2023, expected to inch a little bit higher at 67 in 2024, but still enough room below that 70% to give us that sense of safety. In terms of the DCF per share, well, again, it has been increasing, not hugely inconsistent either, 372 to 548, but we do want to draw your attention to the fact in 2024 it is expected to drop very slightly. We do note on the DCF per share growth the inconsistency, some years single digit growth, some years double digit, as well as some years negative, like the expectation in 2024. And we also note the cyclicality of the industry, with the sales growth showing 3 out of the last 10 years with double-digit negative growth, although we can see in between those points they did have some very nice increases to the top line. Top line then going from 38 billion to 44, and we do, similar to EPD, note the fact that they do dilute your position over the longer term, from 840 million shares outstanding to 2.06 in 2023. Moving on then, what we see here on the ROIC, pretty consistent. We're looking for 3 to 5% for pipeline industry, and over the last 5 to 6 years it has been around that, so that is fairly positive to note. It is at the upper end of the expectation. Also nice to note on the operating margin side, the operational efficiencies, with their margins increasing from 9% in 2014 to 21% in the more recent year. Net debt to EBITDA then, nice to note it has been coming down, 4.69 with a maximum of 4.5 for what we want to see in the pipeline industry, 4.41 expected in 2024. So we can see that management are moving in the right direction. Balance sheet seems to be okay for now, and the dividend also seems to be safe. So in terms of the valuation for ENB on today's episode, the intrinsic value is made up of the models that we see on the screen, and this today arrives at a price of $40.43. Now, current price, that margin of safety at 10%, a buy up to $36.39. At 15%, we can see it isn't quite there yet, so we have a 10 to 15% MOS level for today's episode. In terms of Wall Street, well, they have a price target of just under $40 with upside of 10% with this company that does have a nice starting yield. We then move on to the next company, which is Dominion Energy, now down 13% over the last 12 months. Over the last 10 years, down 31%. We do see its all-time highs around that pre-pandemic level of $90 in February 2020. Now, in terms of the current yield, it sits at around 5.56% with a forward P of just under 16. In terms of the dividend safety, we have a score of 70. It does look to be safe with market cap of 40 billion, a large cap company. Now, in terms of the recessionary metrics, pretty positive. We see an increase to the dividend in the last recession, average growth in negative 13%, and also outperformed the S&P with their negative 34% return. Now, they haven't increased the dividend since 2021, and in fact, there was a dividend cut, hence the negative 4% over the last 5 years. Over the last 20 years, however, increasing it by 4% on average year on year. Now, when we take a look at dividend yield theory, we get that double undervaluation signal with a 5.56 yield versus that 5-year average. And we can also see the forward PE 15.8 below the 5-year average of 18.5. And when we compare it to the utilities sector PE, it is exactly the same. So it is around the sector PE 15.8. Now, in terms of the payout, as always for utilities, they are more volatile in terms of the cash flow, so we focus on earnings below 75% for the majority of the utilities industry. One thing to note here is they paid out more in dividends than they generated in earnings in 2023. Not a great sign, but positive to note in 2024 they are expecting to reduce this down to 88%. When we take a look at the earnings per share, what we can see is that it did increase from 2014 to 2022, although pretty inconsistently. We see a huge drop in 2023, but we do know in 2024 it is expected to rebound pretty strongly to just over $3. In terms of the earnings per share growth, again, very similar to a few of the other companies we've analysed today. Pretty cyclical, and hence it shows in the positive followed by the negative, not just in the EPS growth, but also in the sales. As a reminder, remember, buy these cyclical companies when they are completely out of favour. Total sales then going from 12 billion to 14 billion over the last 10 years, with the shares outstanding going from 585 to 837. Now, in terms of the ROIC, around 7.5 or more for the utilities industry. They have struggled with that over the last 10 years. We can see over the more recent period around 5%, which is really the bare minimum that we want to see for this sector. Operating margin side, positive to note, they are above the 18% we do target for utilities, just under 30% over the last 3 years. So with regards to the operating side and the efficiencies, that does look pretty positive. One area that we would like to see a bit of improvement is on the net debt to EBITDA. Whilst we want to see below 5.5 for utilities, we do note in 2023 they did go quite significantly higher at 6.91, although we do understand the transition is expected to be lower in 2024 down to 6.36, still a little bit away from the 5.5 maximum we want to see, so something I would advise to keep a close eye on moving forwards. So in terms of the valuation, for today's episode of Dominion Energy, we get to the intrinsic value as the average of these two prices, coming to $51.90. Now, with the margin of safety at 10%, we can see it isn't quite there yet. So for Dominion Energy, we see a 5 to 10% MOS level. With Wall Street, well, their expectation is that the price is going to increase around 10%. Price forecast of $53 over this 12-month period. As always, let me know your thoughts in the comments below. Are you adding any of these undervalued high-yield dividend stocks? Are there any that you already hold in your portfolio, maybe looking to add more if the price reduces, or some of these prices are at a very good price for yourself? As always, if you enjoy the content, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. And don't forget, you can grab a copy of the valuation model if you want to get to the intrinsic value, as well as the acceptable buy price of companies in your own portfolio, companies on your watch list, or even if you want to run through the companies we did based on your own estimates today. As always, have a great day. See you on the next episode, and for now, take care.